Hi guys, in this video we are going to discuss a very hot topic these days, that is the RBI's new bad loan resolution framework. At the end of the video we are going to discuss some important MCQs based on this topic. So let's start by looking at the relevance of this topic. So with respect to NABARD, this is relevant for the ESI portion. With respect to the topics, development of banking and financial institutions in India, reforms in banking financial sector. And with respect to the RBI, this is relevant for the FM portion and can be asked under the topics regulators of bank and financial institutions, Reserve Bank of India functions. So these are the headlines which you might have read about in the newspapers recently, that RBI has came up with new bad loan rules or the new rules on non-performing assets, and all the newspapers had some differing opinions on these new rules. Some felt that these may improve the prospects of loan recovery, and some felt that this may increase the provisioning requirements at the bank level, and some felt that in the long run these rules are healthy for the economy, though capital shortages may rise again in the short term. Also, some felt that this new resolution framework may push more big defaulters to bankruptcy. Now, before actually coming to the guidelines, it is important that we recognize that why the need for these guidelines was there. The need was there because the non-performing assets in the Indian economy were rising at an alarming rate. In the public sector banks, as on 30th of September 2017, the figure of non-performing assets was really high. It was around rupees 7,33,970 crores. And for private sector banks, this figure was around 1,02,808 crores. So this rising figure of non-performing assets prompted RBI to come up with the new set of guidelines. Now RBI wanted that the process of NPA recognition as well as their resolution should be made very fast. It should be a very effective process, and it should be taken care of that NPAs or non-performing assets do not remain hidden, because if they remain hidden, they may get evergreen, they may continue forever. And if they continue forever, their realization will get increasingly difficult. If the stress is recognized at an early stage, we can realize a better value for that stressed assets. So this is the backdrop which prompted RBI to launch this new set of guidelines for NPAs. So here are the aims, objectives and rationale of this new policy. Now these new set of rules are aimed at creating a harmonized and simplified generic framework for resolving stressed assets in India. They are aimed to provide a wake-up call for defaulters that if they default on their loans, strict actions in a timely manner will be initiated against them. Also, the Financial Services Secretary recently said that government is determined to clean the things up. Now the various schemes which were there at an earlier stage have all been withdrawn, and now the approach is to take the issue up front and finish the menace of non-performing assets. So now with the new bad loan resolution framework being launched by RBI, all the earlier schemes like corporate debt restructuring, strategic debt restructuring, and scheme for sustainable structuring of stressed assets or flexible structuring of term loans will no longer exist. Also, there was a joint lenders forum which was there to collaborate or coordinate with respect to resolution of large consortium loans. So this has also been disbanded with the launch of new guidelines by RBI. Also, all the accounts, and including such accounts where any of the schemes though had been invoked, any of the earlier schemes like corporate debt restructuring etc., but it was not yet implemented. Now that account will be governed by the revised framework and not the old framework. So this is very important to remember. So here are the key pillars with respect to the new framework of RBI with respect to the bad loan framework. Now in this framework, we are going to discuss about early identification and reporting of the stressed assets. Now if the stress is identified at an early stage and proper reporting is done, next stage is to initiate proper resolution plan for resolving the stressed assets. We are going to discuss how this resolution plan is to be implemented and whether some independent credit evaluation is going to be required for this resolution plan, and what are the cases in which this evaluation will be required, and when these structured accounts will be upgraded to normal standard accounts, and how the income is going to be recognized on the restructured accounts, whether it is going to be recognized on accrual basis or on cash basis. And if the resolution plan is not really effective, and if the stressed assets are not resolved properly, and if the resolution plan is not implemented within a specified timeline, then these accounts will be referred to insolvency and bankruptcy code. So we are going to discuss all these key pillars in our video. So the most basic pillar of the new guidelines is the early identification of stress. So the guidelines provide that lenders shall identify the stress in the loan accounts at an initial stage, and immediately on default the accounts shall be classified as special mention accounts as per the criteria provided. So there would be three categories of special mention accounts: SMA 0, SMA 1, SMA 2, and the basis for classification is also given. If the period of default is between 1 to 30 days, then 0 31 to 60 days, 1 61 to 90, then 2. So this is the basis of classification. Now also the RBI's mandate provides that if once an account is marked as stressed in one bank, all other banks will have to acknowledge that and start following the standard procedure. So this has been done to bring some sort of uniformity in the whole banking system with regard to recognition of stressed assets. Now, early reporting of stress. This is also a very key feature of the new guidelines. Now, these provide that lenders shall report credit information, including classification of an account as a special mention account, to Central Repository of Information on Large Credits. So the information will be reported for all the borrower entities which have aggregate exposure of 50 million and above with them. The main report will be required to be submitted monthly. However, lenders shall report to CRILC all the borrower entities in default. So all the borrower entries which are in default and with aggregate exposure of 50 million and above shall be reported on a weekly basis. So in this case, a reduced timeline is there. So the focus is on fast tracking resolution of stressed assets. Now for implementation of the resolution plans, these guidelines provide that all the lenders have to put in place some policies which have to be approved by their board for resolving the stressed assets. Also, timelines have to be provided for their resolution. As soon as there is a default in the borrower entity's account with any of the lender or the bank, all the lenders, so all the banks will be initiating steps to cure the default. Now the resolution plan may involve any action plan or reorganization, or it may involve regularization of account on payment of all other dues by the borrowing entity, selling the exposure to other entities or investors, change in ownership, or restructuring. So resolution plan may have a very wide scope. It may involve any of the things to resolve the stressed assets. Now, structuring is an act in which a lender, the person who has given the money, for economic or legal reasons relating to the borrower's financial difficulty, grants him some concessions. So under restructuring, some concessions are granted by the lender to the borrower. Now this may be done due to signs of financial difficulty, and the guidelines have also provided a non-exhaustive list of the signs of financial difficulty. So if we look at some of them: irregularities in cash credit overdraft accounts, failure to make timely payment of installments, delay in meeting commitments, excessive leverage. So if the debt is very high, then it is also a sign of financial difficulty. Failure to pay statutory liabilities, steep decline in production figures, downward trend in sales, fall in profits, elongation of working capital cycle, delay in project implementations, etc. So these are some of the indicative measures of financial difficulty, and under the conditions of financial difficulty, restructuring has to be done. Now also, if the resolution plans which have been formulated involve restructuring or change in ownership in respect of large accounts, and large accounts here mean which have exposure of 1 billion and above. So if the resolution plans involve restructuring or change in ownership with respect to large accounts, they shall also require independent credit evaluation by the credit rating agencies, which would be authorized by Reserve Bank of India for this purpose. Further, if the aggregate exposure is 5 billion and above, two such independent credit evaluation would have to be carried out by credit rating agencies. Also, the resolution plans have to receive credit opinion of RP4. So this is the minimum rating which a resolution plan has to obtain for satisfaction and for being considered for implementation. So what is RP4? Now RP4 is something which falls in the middle of the hierarchy of the credit opinion of the credit rating agencies. So if the opinion is RP4 or 3 or 2 or 1, the resolution plan would be considered for implementation. RP1 is like highest degree of safety, 2 is for high degree, 3rd is for adequate degree, and 4 is for moderate degree, and all these are for safety. And if there is a risk of default, it may be moderate, high or very high, then the plan will not be considered for implementation. Now in respect of the accounts which have an aggregate exposure of 20 billion and above, the resolution plan has to be implemented within 180 days from the date of default. And if the plan is not implemented as per the timeline, lenders shall file insolvency application with the Insolvency and Bankruptcy Code within 15 days. And for other accounts where the exposure is above 1 billion and less than 20 billion, RBI will provide a 2-year period for which the reference dates and other periods would be announced by RBI. Now these guidelines also provide revised prudential norms with respect to the restructured assets. Now these provide that in case of restructuring, the accounts which have been classified as standard shall be immediately downgraded to non-performing assets. So if standard accounts are to be restructured, they will be downgraded as non-performing asset. And the non-performing assets upon restructuring would continue to be non-performing. They will fall under the same asset classification. The asset classification shall continue to be governed by the criteria which is already existing for such classification. Now let us talk about the upgradation of the accounts. Now if the standard accounts which have been classified as NPA or the NPA accounts which have been retained as such on restructuring are to be again classified as standard account, they have to fulfill this criteria. They can be upgraded only when the outstanding loan in the account demonstrates satisfactory performance. Now what is this satisfactory performance? Now let us understand this through an example. So if the repayment period of a loan is extended from 10 years to 15 years, the borrower must make its payments regularly as per the new schedule, and when at least 20% of the outstanding loan and interest is paid back, the loan can be upgraded to standard account. So we can say that now it is demonstrating satisfactory performance, so it should be upgraded to standard account. But for the loans in large accounts where the exposure is rupees 1 billion and above, there is an additional criteria which has to be satisfied. The rating of investment grade or better has to be obtained by the accredited credit rating agencies for their upgradation. So this is additional point which is there for upgradation of large accounts. Now the guidelines also provide the framework for recognition of income on structured accounts. Now the structured accounts which have been classified as standard assets, so now they have become standard assets. Interest income on those may be recognized on accrual basis. So it provides that we may use accrual basis for recognizing the interest. So interest may be booked even if it is not actually received in cash. And for restructured accounts which are classified as non-performing assets, interest shall be. So interest has to be mandatorily recognized on cash basis for non-performing accounts. Now the guidelines also talk about supervisory reviews, checks and disclosures. So it provides that if there is any failure by the lender in meeting the timeline, or the actions which are taken by the lenders are with the intention to conceal the actual status of accounts, or they may lead to evergreening the stressed accounts. So the lender will be subject to stringent, very strict supervisory enforcement actions. So strict penalty or monetary penalty may be imposed on the lender. Now banks have also to make appropriate disclosures in their financial statements. So whenever banks will be presenting their balance sheets and all, they will have to make disclosure in the notes on accounts relating to the resolution plans implemented. Also, the borrowers who have committed frauds or willful defaults, they will not be eligible for restructuring. So this is a very important point which is there. Now, non-applicability of these guidelines. So these guidelines will not be available in the two cases which have been mentioned in the guidelines itself. Now, first is the revival and rehabilitation of MSMEs as defined under the Micro, Small and Medium Enterprises Development Act of 2006. They shall be continued to be guided by the instructions which have been already issued in this circular. And for restructuring of loans in the event of natural calamity, it shall again be continued to be covered under the directions which have been issued under this order by RBI. So what would be the impact of these new rules which have been issued by RBI? Now the immediate impact that is perceived is that it will lead to growth of NPAs. Why? Because the recognition has become more stringent. Now the recognition will be very fast, and with the recognition NPAs may grow in the initial stage. And if the NPAs are not resolved effectively and within the timelines provided, there may be rush on the insolvency courts under the Insolvency and Bankruptcy Code. Also, the haircuts that banks have to take may increase. So banks may have to forego more amount on their outstanding stressed assets. So this may involve more amount of recapitalization bonds that may be required, because banks will be needing more of the funds to fulfill the deficiencies arising from the haircuts they are taking on stressed assets. Now let us discuss some MCQs based on the topic we have just covered. Recently RBI introduced guidelines for resolution of stressed assets. Which of the following schemes would now be withdrawn as a result of these new guidelines? Corporate Debt Restructuring CDR, Strategic Debt Restructuring SDR, Scheme for Sustainable Structuring of Stressed Assets S4A, all of the above. So this we have already seen that all of these schemes would now be withdrawn. So answer would be D, all of the above. Who of the following is incorrect? Which of the following is incorrect regarding early reporting of stress under recently introduced guidelines by RBI on a resolution of stressed assets? Lenders shall report credit information including classification of an account as SMA to CRILC where the exposure is Rs 50 million and above. CRILC main report will be required to be submitted monthly. Lenders shall report to CRILC all borrower entities in default with aggregate exposure of 50 million and above on daily basis. All are correct. So in this case, option number C is incorrect because this reporting is to be done on weekly basis. Which of the following conditions are required to be satisfied for upgradation of large accounts where aggregate exposure is Rs 1 billion and above as per recently introduced guidelines by RBI on resolution of stressed assets? The account should demonstrate satisfactory performance. It should be rated as an investment grade by the credit rating agencies accredited, both A and B or none of the above. So this we have seen that large accounts would require both these conditions to be satisfied. That is, they should have satisfactory performance as well as investment grade rating. So in this case answer would be C, both A and B. As per recently introduced guidelines by RBI on resolution of stressed assets, interest income in respect of restructured accounts classified as non-performing assets may be recognized on cash or accrual basis, shall be recognized on cash basis, shall be recognized on accrual basis, or none of the above. So for accounts which have been classified as non-performing assets, the guidelines tell us that income is to be recognized on cash basis. So answer would be B, shall be recognized on cash basis. Recently, RBI introduced new set of guidelines for resolution of stressed assets. These guidelines will not be applicable on the revival and rehabilitation of MSMEs as defined under the Micro, Small and Medium Enterprises Development Act of 2006, restructuring of loans in the event of a natural calamity, or both A and B, or none of the above. So this we have seen that in both these cases these guidelines will not be applicable. So answer would be C, both A and B. So these are the answers. So guys, this was all about the new rules issued by the RBI on bad loans or non-performing assets. Thank you.